chart patterns tells us a story of where the price is likely to go next. So if you guys can learn these chart patterns by heart, both how to identify them, but also of course where to enter and exit your trades, you will be able to make so much more money from trading. In today's video, we will take a look at some of the best chart patterns out there, and I will show you real life examples of every single pattern, as well as how exactly you trade these patterns. So yeah guys, I really hope you will get some value from this video, and without further ado, let's jump right into it. The first pattern we're going to talk about is the flag pattern, and this pattern is super useful because it appears all the time in the market. We have both a bullish and a bearish version of the pattern. Let's start by taking a look at the bullish version, and the pattern looks something like this. We have a strong move here towards the upside, but after a while the price starts to consolidate and we start seeing sort of short-term lower highs. But after a while, the bulls takes control again and the price continue here towards the upside. The important part of the pattern here is the consolidation, which we have right here. You can see we have an impulsive move followed by a pullback right, and then we have the next impulsive move towards the upside. The most common way to enter this pattern is to enter somewhere around here. So you have your entry point here after the breakout. The stop loss I usually set below the lowest point of the flag, so below this point. You might set your stop loss somewhere around here. As for your profit target, you usually measure the length of the impulsive move up. You take this measurement, measure here from the lowest point, and there is your usual target level. The bearish version is the exact same thing, but the opposite. The pattern starts with a strong move towards the upside, then we see a move here against the direction of the trend that eventually continues down. We usually mark the flag here with a support and resistance line, and the entry point, stop loss, and everything like that is the exact same thing as for the bull flag. The next pattern we're going to talk about is the rectangle pattern. This one is maybe not as common as the flag, but this one is pretty similar because this one looks like this. We have an impulsive move up once again, but then after a while the price start going sideways like this. And one important thing about this sideways movement is that preferably we want this sideways movement right here to be pretty tight. So we want a tight range here going sideways, and the goal of this pattern, this one is also a continuation pattern, meaning that the goal of this pattern is to break out in the same direction as the trend. So the goal of this pattern is to break here towards the upside. The entry point for this pattern is once again usually here at the breakout. However, we do have some other potential entry points, because let's imagine that after the breakout that the price started to fall before we saw the next impulsive move up. Many times traders actually waits here for the retest of the previous resistance to flip to become support before they enter the trade. So this point right here is yet another entry point. If you use this entry point, you want to set your stop loss quite a bit below the low point, so you have your stop loss right here. As for your stop loss, if you use the breakout entry, so if you enter right here, then many times your stop loss will be somewhere here around the 50% mark, and some traders even set the stop loss below the lowest point right here. So some traders even have the stop loss all the way down here. But when they have this kind of stop loss, they usually aim for a profit target that is at least 2-to-1 risk to reward ratio. As for the bearish version of the pattern, the same thing applies, but in this case we have a strong move towards the downside, right? Then we have a range starting to appear here, and as I said earlier, preferably we want this range right here to be tight. We are waiting for either the strong breakout here, or we wait for the price to come down and test this previous support as resistance before we see the move here towards the downside. The next pattern we are going to talk about is the cup and handle pattern, and this pattern is very different from the two previous patterns we talked about. This is a longer term pattern. This is a very large pattern. In a perfect world, the pattern looks something like this. We have a very beautiful and sort of round bottom. The price comes up here, and then we see a pullback, so the price start to go down, we usually mark the pullback here by a resistance and a support line. And the goal for the bullish version of the pattern, this right here is the bullish version, is that we're looking out for the break here of the pullback. However, what is important to notice is that this is how the pattern looks like in a perfect world. In the real world, however, the price will probably look something more like this. You know, in the real world, we very seldom have these sort of perfect kind of patterns. So this is probably more how the cup and handle would look like in a real life market. But now let's take a look at what is the entry point for this pattern. Well, there are two main types of entry points. The first one you're looking out for is that you're looking out for the breakout. So you enter right here, you look out for the breakout of this pullback. So this is pretty much almost like a bull flag that we talked about earlier within this pattern. And then you can use the same, stop loss we talked about earlier. You can, for example, set your stop loss below the lowest point right here. So this would be a stop entry. However, there are another entry point as well, and this one is very common to use, and that is that, we do have some kind of resistance coming in right here. Usually in a perfect world, the price goes up and touches this resistance right here. So many traders actually wait for the breakout above this orange resistance before they entry. So perhaps they have their entry points all the way up here instead. And if you have the entry point, if you have the entry point all the way up there, you usually have a stop loss. It could be around this point once again. But one important thing about this entry is that then you're looking out for many times a larger move. A common way to take profits is that you measure the length from the resistance here. So you measure this point right here, you take this exact measurement, and then you measure here from the breakout. This is what we call the measured move objective, or 100% measured move, and that is a very common target level. If you use the other entry point, the entry point right here, then you usually have a smaller profit target. Many times you use a 2-to-1 risk to reward ratio for your profit target. Now guys, let's take a look at the pennant pattern. This is yet another pattern that appears so often here in the market, so this one you just have to learn about. Super important. Let's start here by taking a look at the bullish version. This one is pretty similar again to the bull flag. It starts with an impulsive move towards the upside, and the price starts to go down here. But instead of printing lower lows like the bull flag, the pennant will instead print both lower highs, right? But at the same time printing higher lows. So the pennant is like a triangle pattern, but it's a very small triangle. So it's a small triangle that we see after a move towards the upside. And what we're looking out for here is the break of this pennant. The entry point for this one is pretty straightforward. Here you pretty much always enter at the breakout. So right here is your entry. As for your exit, you want to set your stop loss below the lowest, the highest low here before the breakout. So you have your stop around here. And as for your profit target, you usually aim for either a 2-to-1 risk to reward ratio, or some traders once again uses the measured move objective. So they measure the impulsive move that starts down here. They take this measurement and measure from this point right here. So if you're aiming for a larger profit target, some traders uses that. The bearish one is very similar. We have an impulsive move here towards the upside. The price start going up here a bit, but we are printing both higher lows, but we are printing lower highs. So once again, we get this sort of small triangle looking structure here, a small triangle. And what we're looking out for here is the break towards the downside. If you are shorting the market, your entry point will be around here, and your stop loss will be below the high, the lowest high right here. so your stop will be somewhere around there. The methods for the profits, you usually use the exact same method as we talked about when we talked about the bullish pennant. Now I want to talk about the classic head and shoulders pattern. This is one of these larger patterns that happens over a long period of time. Most of the times these patterns are the most effective on the longer time frames, such as the daily time frame, maybe the 4 hour, and so on and so on. And let's actually start here by the bearish version of the pattern, which is a reversal pattern, meaning that the price aims to reverse here towards the downside. This pattern in a perfect world looks something like this. You know, we have our uptrend, we print one high, we print a higher high, and then we print a lower high, and then the goal is that the trend will continue down here. So the head and shoulders is basically that we have one high, we have a higher high, and then we have a lower high. One very important thing about this pattern is the support that we can draw. We can draw a support line like this. You can see we had one touch as support right here, and then we have another touch as support right here. And this, I feel like a common mistake that I see a lot of beginner traders make is that they start to talk about the head and shoulders pattern, for example, already when the price is here. But this pattern is not confirmed until we break the support, and preferably when we break the support, we want to see a strong, let me actually use red here, we want to see a strong candle close below the support. And some traders even wait for, you know, a confirmation candle before we get this breakout. So it's really important that we break this level, that we really break this level before we enter. And for the entry point, there are two options here. One way is to enter on the breakout, so you have your entry right here. Another entry point is to wait for the price to retest this previous support, right, as resistance before we enter. So we wait for this another touch, we wait for another touch right here, and we enter perhaps right here when we see some bearish price action coming in at this level. So this right here is two different entry points for this pattern. The most common way to take targets from this pattern is to use something we have talked about earlier in the video, and that is the 100% measure move. So we measure this length right here, we take this measurement, measure from the breakout, so our profit target would be somewhere around here, right? There are a few different methods to take profits. You can use a risk to reward ratio. Many times when you have patterns as large as this one, you have a larger risk to reward ratio. Perhaps you have a, you know, at least a 3-to-1 risk to reward, maybe even a 5-to-1 risk to reward, but it will differ a bit on a case-by-case basis. Of course, we have a bullish version of this one as well. I will not talk as much about this one, but it's basically the opposite as what we recently talked about. In a perfect world, it looks something like this. We print one low, we print a lower low, and then we print a higher low. Then we draw a resistance line, and one important thing about these head and shoulders pattern is that many times the support or resistance line will not be perfectly straight. Many times it tilts in some direction, so it might be, you know, a guy that looks a bit tilted here, but this is basically the what we call the inverse head and shoulders, and this is the bullish version of the pattern. As for the entry point and the stop loss and the profit target, it's the exact same as the bullish version of the pattern. So one very important thing about the chart patterns we talked about in this video is to be able to understand support and resistance. And if you guys want to learn more about support and resistance, I actually have a comprehensive educational video about that. So I highly recommend all of you to watch this video about support and resistance next.